Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at rich tech robotics.
If you find our talks useful, please consider subscribe, like, and comment underneath. And just a quick note before we jump in, you can find a link in the description for a 14-day trial to StockOracle. We use it for a lot of our research on this show. Full disclosure, it is an affiliate link, so we do get a small commission if you sign up, which really helps support the deep dives we do here. Also, remember that AI insights and value estimates can sometimes be wrong. You always have to verify the data yourself.
Right, absolutely.
We are definitely not giving financial advice here, just trying to focus on long-term wealth building, capital protection, and just unpacking the actual fundamentals of these businesses.
Yeah, exactly. Protecting your downside is always step one.
So today, our mission is to dig into this equity research report on rich tech robotics, ticker RR. And I gotta say, this one presents one of the most bizarre structural paradoxes in the microcap space right now.
Oh, it really does.
I mean, imagine holding a winning $300 million lottery ticket, but you're using it to keep a neighborhood lemonade stand afloat. One that literally loses $5 on every single cup it sells.
That is honestly the perfect analogy for what's happening here. The asymmetry is just jarring because on one hand, you have this absolute fortress balance sheet, but it's attached to a core operating business that is entirely unproven and is just bleeding capital.
Right.
It really forces you to completely recalibrate how you model the company's enterprise value, especially if you're looking at this from a long-term compounding perspective.
Yeah, and just to frame the sheer scale of this disconnect for everyone listening, as of June 30th, 2026, Rich Tech is sitting on $301.9 million in cash.
Wow.
Yeah, over $300 million. And they have virtually zero long-term debt. I think the report said it was just a $102,000 liability on the books.
Which is basically nothing at that scale.
Right, it's nothing. So it's a completely bulletproof balance sheet. But then you look at the trailing 9 months of operations, their existing engine, right? They recognized a mere $3.945 million in revenue.
Yeah.
And they burned through $20.4 million in net losses to get that $4 million.
Which is painful. I mean, that puts their net margin at negative 517%.
Right. It's wild.
And when you see a divergence like that, the immediate analytical reflex, at least for me, is you have to figure out the origin of that capital. Because obviously, it certainly wasn't generated by the operating business.
No, definitely not. And the SEC filings tell a pretty aggressive story here. I was looking at their timeline in the report. And just 12 months ago, in June 2025, they only had $32.8 million in cash.
Right.
So to suddenly arrive at $350 million by mid-2026, they essentially had to flood the market with equity. The S1 filing from February shows exactly how they did it. They aggressively expanded the float to build this massive liquidity cushion.
And the structural impact of an equity issuance of that magnitude is just profound.
Yeah.
Because when a company expands its share count that aggressively, it reprices the entire cap table. The enterprise might be flush with cash now, sure, but the claim that each individual share has on future earnings has been permanently diluted.
Which is the opposite of long-term shareholder value creation. Sure. And the market clearly didn't miss the implications of that S1 filing, considering the stock bled out over 40% in the 26 weeks leading up to this report.
Right, it was a brutal repricing.
Yeah, brutal. But it leaves us with this highly capitalized company that now has to somehow justify all that dilution. And they've started ramping up their capital expenditures. CapEx went from $4.8 million to $21.7 million over that same 9-month period. So I guess the big question is, what are they actually aggressively funding?
Well, this is where the emerging growth engine comes in. So the bulk of that infrastructure and R&D spend is being directed toward fulfilling what management frames as our ultimate near to medium term catalyst. And that is a $388.8 million master services agreement in the automotive sector.
Okay, that number jumps right off the page. I mean, $388 million. If they convert even a fraction of that contract, they completely transform their revenue base.
Absolutely.
But, and this is a big but, a master services agreement, an MSA, is a very specific type of legal vehicle in enterprise procurement. It is not a purchase order.
Precisely. And this is a crucial distinction for anyone trying to evaluate the actual business quality here. In enterprise sales, an MSA simply clears the bureaucratic friction.
Right.
It basically means the automotive client's legal team, their compliance, their InfoSec teams, they've vetted RiskTech, they've agreed on the pricing structure, the service level agreements, liability caps, all that stuff.
So it sets the rules of the game.
Exactly. It establishes a $388.8 million ceiling for potential business. But, and this is key, it does not obligate the client to actually buy a single robot.
Wow. Okay, so it's essentially just vendor onboarding. It means, a factory floor manager can order a robot without spending 6 months in procurement purgatory, but they still actually have to write the statement of work and issue the purchase order.
Right. Until those specific purchase orders are executed and the hardware is actually deployed, that $388 million is purely theoretical. It's a framework for future business, not a guaranteed backlog.
Got it.
And this connects directly to the other major expenditure in their pipeline, which is their long-term optionality play. They are rolling out these new DEX-embodied AI robots and a whole new AI data services division.
Now, the data services angle is fascinating to me because the unit economics on their existing business, as small as it is, are actually surprisingly strong.
Yeah, they really are.
Like, their trailing 12-month gross margin is sitting at 55.83%. In the hardware space, that implies they have real pricing power or, a really heavy software component.
It does. It suggests that when they actually secure a deployment, the underlying economics work. Data services for AI training, where you're essentially taking telemetry data from these embodied robots in the real world to feed foundation models, that can carry software-like margins.
Right.
So the structural problem for long-term wealth building isn't the gross margin, it's the total lack of operating leverage right now.
Because the fixed costs are just massive. I mean, you have $21.7 million in CapEx, you have massive SG&A expenses, and they're just completely overwhelming that tiny $4 million revenue base.
Exactly.
And according to the research report, there was absolutely zero revenue, pricing, or deployment data currently available for the new DEX robots or the data services. It's like it's all still in the lab.
Yeah, it's entirely speculative at this stage.
Which brings us to the core tension of the equity.
Yeah.
Right? We have a $300 million war chest, a massive but basically unactivated automotive MSA, and high-margin AI tech in the pipeline.
Right.
In a vacuum, a setup like that should command a massive growth premium, yet the stock is just languishing at sub-$2 levels.
Yeah, and I think that's because in a vacuum, you assume the market trusts the management team to execute. And in RiskTech's case, that trust has been completely shattered.
Absolutely.
If we look at the regulatory filings, they had to issue financial restatements for their 2024 and 2025 results. And if you're talking about protecting capital, that is the ultimate red line for institutional investors.
It is. It fundamentally breaks all your valuation models.
Yeah.
When you have a company trading at 78 times sales, the entire valuation is predicated on highly aggressive forward projections.
But if the baseline historical data, the 2024 and 2025 numbers, if those were materially flawed due to poor internal controls, you were essentially trying to measure a blueprint with a rubber ruler. The market simply will not price in the blue sky future if they can't verify the historical math.
Yeah, you can't build long-term wealth on a foundation you can't trust. And it creates this cascading effect of operational risk. We also see a class action lawsuit in the filings regarding alleged misrepresentations of a Microsoft partnership.
Oh yeah, that's a huge red flag.
Now, obviously we're just reporting the existence of the filings here.
Yes.
We're not judging the legal merits of the suit. We don't take sides on that. But when a microcap robotics firm claims a major tech partnership, algorithmic traders and retail investors buy that narrative aggressively.
Oh, they eat it up.
Right. So when that partnership is called into question, combined with the previous accounting restatements, the narrative immediately shifts from this huge growth opportunity to a massive governance liability.
And that governance liability creates a complete vacuum of institutional support. Smart money, the tier 1 funds, they read the raw SEC Edgar feeds, they see the restatements, and they just step away. They don't even bother. And that leaves the stock entirely in the hands of retail investors and algorithmic trading, which honestly creates massive inefficiencies and data errors.
Oh, the data errors are wild. I actually want to dive into a specific one from the report because it is terrifying if you are trying to model this company using secondary sources.
Yeah, let's hear it.
So if you pulled up RiskTech on a retail finance aggregator like U.com, the platform reported their Q3 2026 revenue at $1.5 million with a tiny net loss of just $0.28 million.
Which sounds great.
Right. If you see that on a dashboard, you think the turnaround is already happening. You think they're basically breaking even and the worst is over.
But then you cross-reference that with the authoritative SEC XBRL filings for the exact same quarter.
Right. The raw SEC data shows Q3 revenue was actually $1.373 million, and the net loss was a staggering $9.91 million.
Wow.
That is a $10 million delta on the bottom line. I mean, how does a discrepancy that massive even happen on these platforms?
Well, it's a direct consequence of the restatements we just discussed. When a company restates historical financials, it alters the XBRL tagging. And for those who don't know, XBRL is the extensible business reporting language that standardizes financial data so software can read it.
Okay, right.
So many third-party data scrapers and APIs, they fail to properly map the corrected historical tags against the new filings. The algorithm gets confused, it mixes adjusted EBITDA with net income, or maybe it drops a massive impairment charge entirely, and suddenly it just spits out a phantom number to the retail dashboard.
So the quants and the institutions looking at the raw SEC data see a company hemorrhaging $10 million a quarter, while a retail investor looking at a secondary site sees a company practically at break even. It perfectly encapsulates why trading around restatement overhangs is so incredibly dangerous.
It really does, and it validates the heavy discount the market has applied to the equity. The fundamentals might show $300 million in cash, but the market is actively pricing in the dilution, the persistent cash burn, and the fundamental fear that the accounting controls are still broken.
Right. So management is staring at a collapsed share price, a shattered reputation, and a deeply skeptical market. They have to change the narrative somehow. And when you have $300 million sitting idle, the fastest way to artificially engineer investor trust is to literally buy back your own stock.
Yeah, the classic near-term catalyst.
Exactly. Hence, the board authorizing a $12 million repurchase program on August 25th, 2026.
And, from a pure capital allocation standpoint, if you just isolate the math, you can see the logic. The stock is trading at a price-to-book ratio of 1.13. If management genuinely believes the intrinsic value of the AI tech and that automotive MSA is not being recognized by the market, buying your own equity at near book value is highly accretive to the remaining shares.
Right.
And the market certainly reacted to it. The stock surged 21.6% intraday just on the announcement.
Yeah, looking at the technical setup after that 21% pop, it definitely created a sharp short-term momentum shift. The stock reclaimed its 20-day moving average at $1.63 and the 50-day at $1.75.
Mm-hmm.
The RSI pushed up to 68.42, showing strong buying pressure, but stopping just shy of technical overbought territory.
Right.
However, and this is a big however, it is still trapped miles below the 200-day moving average, which is sitting way up at $2.70.
Which essentially confirms this is a mean reversion trade within a macro downtrend, rather than a fundamental trend reversal. The buyback provided a floor, for sure, but it didn't change the underlying mechanics of the chart.
Yeah, and this is where I really have to look at the board's decision-making and call into question the entire premise of the buyback as a wealth-building signal. They authorized $12 million. They have over $300 million in the bank.
Yeah.
That means they're using barely 4% of their liquidity to prop up the stock. To me, this looks like a purely cosmetic PR move just to stop the bleeding. Because if trading at a 1.13 price to book was such a generational, accretive slam dunk, where are the Form 4s? I haven't seen a single piece of evidence showing executives buying shares on the open market with their own money.
That is a highly critical observation, and you hit on the exact structural weakness of this catalyst. If the leadership team possessed high conviction in the $388 million auto contract converting, you would expect aggressive open market insider purchasing. Using corporate cash is easy. It carries no personal risk for the executives. The absolute absence of insider buying, utilizing their own personal capital, neutralizes a lot of the bullish signal of the corporate buyback.
It leaves the sentiment firmly in the prove it category for me. They are willing to use shareholder cash to defend the price, but not their own. So synthesizing all of these moving parts, the mountain of cash, the massive unproven MSA, the algorithmic data errors, and the cosmetic buyback. Let's try to model the forward expectations. Let's start with the 3 to 5 year blue sky scenario. If management executes perfectly on all fronts, what does this actually look like?
Okay, so in a pure optimization scenario, and we really have to stress this is an optimistic theoretical maximum, not a baseline prediction.
Right, definitely not a prediction.
The primary domino is that $388.8 million automotive MSA. In this blue sky scenario, RICTech successfully navigates all that procurement friction. They start receiving the actual statements of work, and they begin recognizing multi-million-dollar recurring quarterly revenue by fiscal 2027.
Which finally activates that 55.8% gross margin at scale.
Correct. The DEX robots and the data services deploy into the enterprise, volume scales up, and operating leverage finally kicks in. The massive fixed R&D and SG&A costs are absorbed by this new, much larger revenue base, allowing those high gross margins to flow directly to the bottom line as free cash flow.
And crucially, because they have that $300 million liquidity cushion, they don't have to return to the capital markets to fund that scale-up. So they avoid any further dilution for the shareholders.
Exactly. And in tandem with that operational execution, they deliver consecutive quarters of clean, fully audited SEC filings. They resolve the governance overhang. They settle the class action litigation without a material financial hit. If they achieve all of that, the market entirely re-rates the equity. It transitions from being this distressed, cash-rich value trap to being priced on a forward-looking, growth-oriented robotics multiple. The stock would obviously trade significantly higher than its current levels.
Okay, so that is the perfect execution narrative. That's the dream. But stripping away the optimism, focusing on capital protection, what is the base case? What is the highest probability outcome over the next 12 to 18 months based strictly on the current data we have?
The base case models RICTech remaining a pre-profit, high-cash burn robotics firm. The $300 million balance sheet acts as a concrete safety floor, meaning they have zero immediate liquidity risk, and they are not facing insolvency.
Right.
However, the top-line revenue only grows incrementally from its current $4 million base, meaning the heavy net losses persist.
So the MSA remains mostly theoretical. Maybe they generate a few pilot programs, but not the massive sustained purchase orders they need to actually offset the CapEx.
Yes, exactly. And structurally, the market continues to penalize the equity for the historical restatements. Institutional capital refuses to allocate until there is a sustained track record of clean reporting. Therefore, the stock remains tightly range-bound, likely oscillating between $1.50 and $3, driven purely by retail sentiment and the technical support from the buyback program.
So it essentially enters a holding pattern. The cash keeps them alive, but the lack of trust prevents any real multiple expansion.
Precisely. The cash is a buffer, yes, but it also represents a massive opportunity cost for long-term investors if the business model cannot scale. Weighing the massive potential of the auto contract against the harsh reality of the accounting history, the equity research report assigns RICTech Robotics an overall rating of 4 out of 10, so a firm neutral.
Yeah, that makes a lot of sense. It really is the ultimate standoff. The strongest long-term upside driver is undeniably the conversion of that $388 million master services agreement.
Oh, without a doubt.
But the absolute thesis breaker, the biggest threat that would send this to zero despite the cash, would be another failure of internal controls. If they restate again, the institutional market will permanently lock them out.
Yeah, at that point, the cash pile becomes basically irrelevant because the cost of capital effectively goes to infinity. It is a textbook example of why you cannot analyze a balance sheet in isolation from corporate governance.
It really forces you to step back and look at the broader mechanics of how technology is funded today. And that's the thought I want to leave everyone with as we wrap up this deep dive.
Yeah.
We are watching this massive influx of capital into anything labeled AI or robotics right now. It makes you wonder if a microcap with a history of broken trust can successfully pivot into AI data services purely by outspending the competition with the $300 million war chest. Does that mean the traditional barrier to entry in robotics is just dead?
It's a great question.
Will the next generation of tech unicorns be built by sheer financial engineering and capital brute force rather than actual operational excellence? It's definitely something to think about as you watch this sector evolve. Just a quick reminder, if you want to dig into the numbers yourself, check out the StockOracle 14-day trial link in the description. Just remember our affiliate disclosure and the fact that AI estimates need to be verified.
Yep, always double-check the data.
Until next time, keep protecting your capital and stay rational.